Hi everybody, we're going to talk about Chapter 3, and I figured that I would put this in context for you. So in Chapter 2 we talked about the accounting cycle and what was happening and how to record transactions during the period, and now that we're done with that, we're going to talk about what we do at the end of the period. So that's what Chapter 3 is all about. I thought it might be interesting also for you to see that there's a lot of practical examples for doing things. We're going to talk about how to recognize revenue and how to make adjustments for the revenue that maybe we've earned and haven't gotten the cash for, or vice versa. And so there's a company called SurveyMonkey. I'm sure you've heard of them before. They do online surveys. Anyway, they offer a free basic plan and a premium plan. So the premium plan they bill on an annual basis. It's $780 a year, which works out to be $65 a month. And so a company called Canon signs up for the Platinum plan on December 1st. So they Canon pays the entire $780 to SurveyMonkey for an entire year of surveys, right? So how does SurveyMonkey record that payment? Is all that $780 revenue on the very first day that they get it? I don't think so. I don't think they've earned a dime of that, actually, not on the first day that they get that $780. What do they have to do to earn that revenue? Well, they have to actually go through the period of time. They don't really need to, I don't know if they have a per survey or whatever, but I think it's just a subscription. And so at the end of December, on the 31st, which is when the SurveyMonkey has their year in, they have to stop and they have to say, wait a minute, how much of that $780 that I received on December 1st is actually earned revenue at the end of the month? Okay, so that's the basic question, is how much revenue are they going to recognize during that year? Okay, and that leads us to the revenue recognition principle, and that principle states that whenever we earn the revenue, regardless of when we receive the cash for making that money, that's a separate thing. When we earn that revenue is when we recognize that revenue. So in the case of SurveyMonkey, they actually earn the money at the end of the month, and that's when they recognize that revenue. So where does the revenue go that they haven't earned? That's called deferred revenue, and that's one of the things we're going to get into. Okay, so expenses are matched up with the revenue that's earned. So said another way, let's take SurveyMonkey. They earned that $65. What were the related expenses that were incurred by SurveyMonkey as a result of making that $65 from the company? Okay, so all the expenses could be things like salaries, could be electricity, utilities, whatever web service they host their servers on, the list goes on and on and on. So all those expenses need to be matched up in the same period that the revenue is earned. So that's the matching principle, really important. Okay, so here I've just given you a little example of when cash is paid and when expenses are recognized and when the revenue is recognized, and so on and so forth. So it's just a little diagram. I don't know, maybe it helps, maybe it doesn't. Okay, so there's something called the accrual basis, which is what we're going to be studying in this semester, and then there's a cash basis. So the accrual basis is really where we're going to focus, because that is stating that we will use the revenue recognition concept, which is that the revenue gets recognized when it's earned and the expenses are matched up with that revenue in the same period. Okay, so on a cash basis, then they recognize revenue whenever the actual cash is received, and they recognize the expenses whenever the expenses are paid. So it's a little bit different. Again, we're going to be focusing on the accrual basis. Why? Well, because the accrual basis of accounting is part of GAAP, and as we remember from a previous chapter, GAAP is generally accepted accounting principles. So when we report things on our financial statements, we need to be following the same rules as all the other companies, and the rule is that we use accrual-based accounting. Okay, so there's these what we call adjusting entries. So just like we talked about with SurveyMonkey, there are adjustments that need to be made at the period end. And mostly for this class, we're going to talk about the year end. You could close your books at the end of the month, at the end of the week, at the end of the quarter, but just for our sake of simplicity, we're going to talk about at the end of the year, what kind of adjustments do I make? Now, why do I need to make an adjustment? Well, in the case of like SurveyMonkey, you could see that they received a whole bunch of cash up front, but they haven't actually earned any revenue. When the month passes, then all of a sudden they think, wow, I look back and I go, well, I earned some revenue. Now I can recognize that revenue. So these are what we call adjusting entries, and there's 4 basic kinds, and I list them here. So we're going to go through them. All right. So these transactions are actually from the PowerPoint in Chapter 2, and I've just put in blue what the adjustments are that are required at the year end. So for example, on December 1st, when they paid 1 year of rent in advance for $6,000, then on the 31st of December, then how much rent have they actually used? So if they pay the whole $6,000 on December 1st, they haven't actually stayed in the place yet, so they really haven't experienced any rent expense. It's only when they've been there for a whole month that they can actually say, okay, I used up, in this case, $500 or 1 month of rent. Okay, same thing on December 6th, they've purchased some supplies on account. At the end, they're going to see how many supplies they have left to make an adjustment for that. Another good example is on December 23rd, they received cash in advance for 12 golf training sessions that are going to be done in the future. So here is a kind of an opposite situation as the one on December 1st, where they received cash and it was $600. I'd take cash. If anybody were sitting there giving me cash, I'd say, sure, I'll take your cash. They took all of the cash, even though they hadn't earned a nickel in revenue yet. It's only when they hold those golf training sessions that they'll actually earn that revenue. So we have to put that $600 in what we call a deferred revenue account or an unearned revenue account until at which time we earn the revenue. Okay, so prepaid expenses are when so these are called the prepaid expenses. So the rent expense was an example of an expense that I'm going to pay for in advance and then use up later. Okay, and a prepaid insurance might be another example. In this case, if I pay $1,200 cash for insurance, but again, I haven't used up any on the day that I pay it on December 1st, then I put the whole thing into a prepaid account. So my entry would be $12,000 prepaid insurance debit, cash $12,000 credit. Then when December 31st comes, you can see that now I have actually used up some of the insurance just by the passage of time, and so I'm going to expense the amount that I've incurred. Now, how did I get $1,000? Well, I paid $12,000 for a 1-year policy. It doesn't say that, but it's a 1-year policy, so it's $1,000 a month. So here's my expense just for the month of December, and then I take it out of my prepaid insurance account. And I still have $11,000 remaining in my prepaid rent account, and prepaid rent is an asset to me because I haven't used it yet, even though I've paid for it in advance. Okay, and here's the example of the rent. I paid for all my rent up front, and then that was on December 1st. On the 31st, I make an adjustment for the amount of rent that I have used or that's expired, which is $500. How do I get that? Well, $6,000 divided by 12 is $500 a month. So that's how I get that. So here's my adjusting entry, rent expense. I debit that, increasing my expense by $500, and I decrease my prepaid rent account, which is an asset, meaning I now have $5,500 remaining in prepaid rent, also an asset. Okay, in the case of supplies, it is a pseudo prepaid expense. What typically happens with supplies is that I buy a whole bunch of supplies. Maybe I buy $2,300 worth of paper clips, and I put them in my supplies account or in my closet. And then throughout the month, people come in and get 10 paper clips, 11 paper clips. But I'm not going to keep track of all that. I'm just going to look, and at the end of the month, I'm going to go into my supplies closet, and I'm going to go, well, how many supplies are left? And whatever is not there is the expense that I've incurred for the month. So in this case, they bought $2,300 worth of paper clips. At the end of the period, they have 1,300 paper clips left. That means that they must have used 1,000. So this is like I call it a plug. It's how much is going to make sense, because if I started with 2,300 and I wound up with 1,300, that means I must have used 1,000. That's how you'll typically see supplies. Okay, another type of an adjustment is called depreciation. So in this case, the company purchased a piece of equipment for $2,400. When it's brand new, that's what it cost. But if they've used it throughout the month, just like if you buy a brand new car and you drive it around for a month, it's not going to be worth the same amount as when you drove it off the lot. Well, the same is true of equipment. So the difference between what I paid for the equipment, in this case $2,400, and what it's actually worth a month later is called depreciation. So the difference between $24,000 and $23,600 is $400. You don't have to worry about how they got that $400 for now. Just they gave it to us, so we're going to use it. Later on in the next chapter, we're going to find out how to find that $400. But for now, all you need to understand is the depreciation expense, and that's the concept that we're trying to get across here, is how much the equipment has gone down in value as a result of us using the piece of equipment, which is what it's there for, so that's good. But it is now called a depreciation expense, and then the other part goes in a contra account, which I'm going to discuss later, called accumulated depreciation. Oops. Okay, so this is an example of how accumulated depreciation might appear on a balance sheet. So here you've got all your property, plant, and equipment, and it totals a certain amount. Don't worry about the numbers. These don't really relate to my previous example, so don't get all excited. And this is the accumulated depreciation, showing us what the net value is of our property, plant, and equipment. So said another way, if you paid $30,000 for a car, you drove it around for a month, and then let's say it depreciated by $1,000, then you would account for that $1,000 as a depreciation expense. And the reason you do that is because if I were to ask you, well, how much is your car worth? You wouldn't tell me $30,000 because that's what you paid for it. You'd actually tell me what it was worth today. So the difference between those values is how much it has depreciated. Okay, so we'll put the clutch in and shift gears a little bit. Now we're going to talk about another kind of adjusting entry, and that's called deferred revenue. So this is what happens when a company gets cash in advance but hasn't done anything to earn that money. So let's say I have a Wall Street Journal subscription and I pay $120 on January 1st so that the Wall Street Journal will be delivered to my house every single day except Sunday, and that will happen over the next year. So if I give them cash of $120 on January 1st, how much revenue have they earned on January 1st? Zippo, zilch, nada, none, right? At the end of January, then how much revenue have they earned from me? Well, they've earned 1/12 or $10 of that $120 that I paid them in advance. So for the Wall Street Journal, they have what's called deferred revenue. So they've received my cash, but they haven't actually earned the revenue. They only make an adjustment at the time in which they have earned that revenue. And in the case of me, they've delivered my paper for the entire month of January. So at the end of January, they can make an adjustment saying, hey, I've now earned $10 from delivering that newspaper. So I thought I'd show you how this looked like. In this case, the $600 was received from a customer in advance of the company actually providing any service. So the initial entry was a debit to cash because it's an asset. They took the cash in, and the credit was what we call deferred revenue, which is a liability to this company until at which time they earn the revenue. So this was the initial entry that I made when I got the $600 from the customer. Now, when time elapses and they actually provide the service, or the time passes in the case of something like rent, then they will go ahead and recognize some of that revenue. So in this particular case, the company provided services of $200, so now they're going to take $200 out of the deferred revenue. Remember, I put $600 in, so now what I'm saying is, hey, I have $600 of unearned revenue in the beginning, but then when I make the revenue, I'm going to take it out of that deferred unearned revenue account and go ahead and earn that revenue. So this is called an adjusting entry. Okay, so that would be kind of what this would look like. So it is a liability, so it gets listed with all the other liabilities on the balance sheet. Okay, accrued expenses. So this is like the flip side of that one, where they are experiencing or incurring an expense, but they haven't actually paid for it yet. So that's an accrued expense. Okay, so the cost is recorded as an expense, and it's recorded as an expense, and they credit a liability account because they're still needing to pay for that. Okay, so in this case, if a company is hiring people and they have employees that are making money, they don't necessarily pay them every single day, which is very common, but they have accrued an expense as a result of the employees working. So they go ahead and recognize the expense and they put it into a payable account until at which time they pay their employees. So this is an accrued expense. And then when they earn an additional, in this case $400, then they're going to pay out the salaries here. But the midterm adjustment between December 28th and December 31st, remember we're closing out our books, so we kind of have to take a pause and say what's going on as of the 31st. Well, in this case, I've incurred expenses for hiring my employees from December 28th until the 31st. So that's why they put that $300 there. Okay? Another example is interest. So if I take out a loan and it's at 12%, that's an annual rate. So if I took it out on December 1st, then on the 31st I incurred $100 of interest, which is 10,000 times 12% divided by 12, which you can see up here is $100. So on the 31st, I'm going to recognize the fact that I have interest expense. I have interest expense of $100 as of the 31st. Even though I haven't paid that interest yet, I've still incurred the expense. And the last example is accrued revenue, where maybe I've made the money, but my customer hasn't paid me. So that's accrued revenue for me, and accrued revenue is an asset to me because I've made the money, I can recognize the revenue, but I haven't been paid it, so I'll put in an accounts receivable for the money that I'm owed. So for example, here on December 28th, I've earned $700 from the 28th to the 31st, haven't been paid, so I'm going to issue that. I'm going to put that in as revenue. Here's my revenue. Okay, sorry, that $700 should be over here. And my accounts receivable will be debited, meaning that I'm owed that money. That accounts receivable is an asset to me. So now that we have recorded all of our transactions and we have made our end of period adjustments, those adjusting entries that we just talked about, now the next thing that we're going to do is an adjusted trial balance. And this is going to, so the next steps that I'm taking you through are actually completing the accounting cycle. So again, we started out with recording transactions, making adjusting entries. Now we're going to make sure that we have properly recorded all of our debits and all of our credits. And there's no better way to do that than to simply list all of the debits that we have balances for, and all of the credits, and hopefully the debits equal the credits. Now, if they don't, we know that we have to go back to our general journal, back to our general ledger, and see where our error is and where we may have made an error in the transaction posting or the addition or whatever. But this will tell us that we're on the right track. So if my debits equal my credits, then again, I'm on my right track. Okay, so here I've kind of made some color coding for you, and I hope this is helpful. So everything that's in green right here, right, are the assets, and then the liabilities, and then these pieces right here in kind of this red are part of the owner's equity. The ones that are in blue, which are the service revenue and all of the expenses, those belong on the income statement. So here, in the spirit of color coding things, again, I've got my assets and liabilities, my stockholders' equity, and then my income statement. So that just gives you an example of which accounts go on which statement. All right, this is an example of what the income statement is going to look like. Here's my service revenue, here's my rent expense, which should be over here, and those are my total expenses, and this would be my net income, which is simply my revenue less my expenses. Okay, so there is my net income, and then I have my stockholders' equity. So this is how to read the stockholders' equity. So here I start out. Now remember, in our case, this was a brand new company, so we had no beginning balances in our common stock, retained earnings, and nothing there. Okay, then we issued some common stock. And so we issue that for $25,000. So $25,000 goes over here to my total. This is a total column. Then I'm going to add my net income for the period. Where did I get that? Well, I got that on the previous slide, because remember, we had net income of $1,200. So that's where this goes, right over here. I paid dividends, which were part of the transaction history that I had. So I subtract this because that was paid out, and I come up with ending balances. So 25,000 plus nothing else is 25,000. Then I have net income coming in of $1,200, but I paid out of that. I paid, basically that comes from my equity account. The dividends is an equity account. So there, my ending retained earnings is $1,000, meaning 25,000 plus 1,000 is 26,000. And that is my statement of stockholders' equity. Now, next year, my beginning balance in my common stock account is going to be what? That's right, it's going to be the ending balance this year, or it's going to be 25,000. Same with retained earnings. I'm going to have a $1,000 beginning balance at next year's statement closing. So hopefully that makes sense. All right, and then this is my balance sheet. So here are all of my assets. Those are my current assets, meaning that they are coming due, or they will be converted to cash, or are cash, within 1 year or operating cycle, whichever is longer. So if I have an operating cycle of 18 months, then it would be whatever's coming due in the next 18 months. Then I have things that are longer term assets. So for example, a piece of equipment is hopefully going to last me longer than a year, so that's why I claim that that is a long-term asset. And there you can see the depreciation that we took right there. So then I add up my current assets, my long-term assets, I come up with total assets. These are all of my current liabilities. Again, the same concept here, which things are due in the next year or operating cycle, whichever is longer, and which things are due in longer than a year. So remember our notes payable, I think we took that out for 3 years, I believe. Anyway, it's longer than a year, so that goes under my long-term liabilities. Oops, sorry. And then there's my common stock, my retained earnings. Where did I get these numbers? From the statement I just created. There's my total stockholders' equity. If I add this plus my liabilities, I came up with $40,000, which equals the assets, which is a really good piece of news that my assets are equal to the liabilities and stockholders' equity. Now, the next thing I'm going to introduce to you is the different types of accounts. So the accounts that are found on the income statement, I'm going to go back to this slide for a minute. The accounts that are found on the income statement, which are these, the revenue and the rent expense, those are called nominal or temporary accounts. And everything else up here in the assets, liabilities, and owner's equity is a permanent account. So those stay on the balance sheet. Now the idea here is that we're going to close out our nominal or temporary accounts at the end of the year so that we can start with zero balances at the starting of next year. So in this case, you can see that I've made $7,200 in service revenue. All right, and that was for the year, whatever year this is, 2018. And then in 2019, I really need to start with a clean slate so that I know how much revenue I've made in 2019. So how do I do that? Well, that's when we close out accounts to retained earnings. So I'm going to skip forward to the next slide I was going to talk about. So here the idea behind the closing entries is we're going to transfer the balances of all those temporary accounts, the revenues and expenses, out to retained earnings. So how do we do that? Well, it's actually not too painful. So here, do you remember our service revenue had a credit balance of $7,200? Now check this out. If I had a credit balance of $7,200 and I make a debit entry for $7,200, what's my ending balance? That's right, it's zero. So by me making this debit entry to service revenue is going to zero out my service revenue. Now I can't just erase it off my books, and I would never want to. So what I do is I put that $7,200 in retained earnings, which is a credit account under owner's equity. So I'm actually decreasing and increasing under the owner's equity. Okay, the same thing happens with my retained earnings and my expenses. So here I'm making a credit entry to an expense account. And if you think about it, the natural balance for an expense account is a debit. That's the way I increase an expense account. So if I make a credit entry to rent expense that had a balance of $500, that balance is going to go to zero. I'm going to transfer that up to my retained earnings. So these are all my expenses. They equal $6,000. So I'm going to make a debit entry to retained earnings, which decreases retained earnings. And here are my dividends, which are also getting closed out to retained earnings. Dividends has a natural balance of a debit. So if I make a credit entry, it winds up at zero, and that is a debit entry to retained earnings, which also serves to reduce that. So check this out. It's kind of wild. If I take $7,200 minus $6,000 minus $200, I'm going to come up with $1,000, which was the ending balance in my retained earnings. And just so you keep tracking with me, do you see that retained earnings here? That was my net income, that was my dividends, and here's my ending balance in retained earnings. So all I'm doing is taking the net income and taking it out of the revenue and expense accounts and putting it into retained earnings. And here's a happy little T account with the retained earnings. There's my $7,200, which was my revenue. There's my expenses. There's my dividends. Gives me an ending balance of $1,000. Okay, so then we're almost done. What we're going to do is a post-closing trial balance. You will notice on here on this post-closing trial balance, which is different than the other trial balance that we had, there are only assets, liabilities, and stockholders' equity on here. And again, all the debits equal the credits, and everybody's happy. Okay, so the next thing we're going to do, is work on our great adventures. So I'm going to bring up chapter 3, and this deals with questions 12 through 19. And Great Adventures does kayaking trips. That's why you have this happy little picture here. So I'm going to switch over to Connect. Actually, before I do that, I'm also going to mention in these slides that I have a whole bunch of concept checks that you are free to go through on your own. These are not graded. These are just to help you see how close you are to understanding things. So I'm going to hop over to Connect, and I'll explain how to finish Great Adventures. And I'm in chapter 3 homework right here. You can see I've switched into the student view, so hopefully it'll look very familiar to you. And some of these are repeats of what I've said, and just to help you understand, I'm going to cruise on over to the last part, which seems long, but I think it's manageable. So this is a continuation problem that we started in chapter 2, and there were some July transactions over here. Now we're getting into the August transactions. So all you are to do here is to start recording the transactions. Okay, so for example, if I sold, there it is right there, I sold 10,000 shares of common stock to Susie, then I'm going to make my journal entries over here. So I'm going to take in the cash, and I'm going to credit my common stock for that $10,000. Okay, so that's how that goes. So there are quite a few transactions, and that's what we have listed up here. And I think you can get the idea here. You also can refer to the book. And then these are the adjusting entries right down here, which is kind of what we've just talked about. So here's some depreciation of the mountain bikes purchased on July 8th. So that is a debit to depreciation expense and a credit to accumulated depreciation. So I'm actually looking in my book right now, and I can see that on page 116 it gives me an example of how the entries look for the first adjusting entry, which is depreciation. Then when I say that 6 months worth of insurance has expired, I'm going to come back up here, and I can see that the prepaid insurance has a balance of $4,800, and here they tell me that 6 months of it has expired. So I'm going to take the monthly amount and go ahead and include insurance expense for the 6 months that's expired. To give you further clarification on the insurance, I'm looking back at the July transactions, which we covered in chapter 2. It's not exactly clear when you get to chapter 3, and it says I purchased a 1-year insurance policy for $4,800, which is $400 a month. So when I come over here, I can see that there's my $4,800, and they tell me that 6 months of it is expired. So if it was $400 a month, 4 times 6 is $2,400, and that's where I get the adjustment for that. And then moving on, it says 4 months worth of the rent has expired. And this time it does tell me right up here on September 1st, it said the company rents a storage shed purchasing a 1-year rental policy for $2,400. So they paid cash for that rental up front, which is $200 a month, and that was on September 1st. So how much is expired when I go to make my adjusting entries on December 31st? I've got September, October, November, December. That's 4 months for me. So 4 times $200 a month is $800, and that's the entry I'll make there. And then you just do the rest of these. So of the $800 of office supplies that were purchased on July 4th, again in chapter 2, only $300 remain. So if I started with $1,800 and I now have $300, that means I must have used $1,500. So that's what my expense is for my supplies, and I take it out of my supplies, I take it out of my supplies account. So I've got a debit to supplies expense because I used it up of $1,500. Take it out of my supplies since it's not there anymore for that same $1,500. When I credit a supplies account, that is an asset account, which means it's going down. So far so good. Okay. So then it tells me interest expense on the $30,000 loan on August 1st should be recorded. So let's go back and say, all right, so on grade, they have a $30,000 low interest loan, and the loan is due in 3 years, and it's got a 6% annual interest rate. Okay, so if I take $30,000 and I multiply that times 6%, I get $1,800, and that's the annual interest. So if I take it out on August 1st, by the time December 31st rolls around, I will have incurred August, September, October, November, December. I've got 5 months worth of interest, and that interest is $150 a month. So I multiply that times 5 and I get $750. And that's how much interest expense I've incurred for this year from August 1st to December 31st. Okay, this is very similar to the one up here with the office supplies. I've got racing supplies. I started out with $2,800. I've only got $200 left. That means I've used up to $2,600. And finally, Susie calculates that the company owes $14,000 in income taxes. I'm not going to ask you how that was calculated. If you're interested in that, you can take an income tax class, but we're not going to talk about that in this class. So we're just given that amount. So that's an interest expense to me. I haven't paid it. There's no indication that they paid that, so it's going to go to an income tax payable account. So those are my adjustments right there. So up top, this is where I did all of my general journals, which were basically August 1st through December 31st. Then I make my adjusting entries down over here, and then finally, as I post either my general journal or my adjusting entries, I'm going to go ahead and put my balances in here, and this would be a date field right here. So whatever my date is, I'm not saying that's the right date, and put the amount in here. If you have a credit entry, you'll put the amount here with the credit date over here. Okay, so that's how that one works. Alrighty, and then finally we'll have an adjusted trial balance. So that will be a list of the accounts followed by the debits and the credits, which is why this area is so important over here, because you're just going to come up with an ending balance for everything, and then you're going to put the account over here. So again, you'll list all your assets followed by your liabilities, followed by your stockholders' equity, followed by revenue, followed by expenses. You'll put all your debits in the right place, all your credits in the right place, and then you'll create an income statement with your revenue less expenses, that statement of stockholders' equity. If you forgot how to do that, you can go back to the part of the video where I described that, and then finally prepare that balance sheet. Okay, the last entries are to close out the revenue account to retained earnings. So here you would make a debit to revenue, which will get that out of there, and a credit to the retained earnings for the amount of the revenues that were listed up above. And then you'll post these, yeah, those are your revenue accounts. Sorry, then you come over here to your expense accounts, then your dividend accounts. That's the final balance in your retained earnings. And then you'll finally list again your assets, your liabilities, and your owner's equity. No dividends, no revenue, no expenses over here. Come up with your total assets and liabilities, and you're done. Now, that sounds like a lot of work. I'm going to post some worksheets for you that also, if you want to work on it offline and then transfer your information back to Connect, I'm going to do that for you. And also I'm going to post some check figures for you, so that when you're on this part right here, you know that if you have an ending balance, you can check and make sure that that's the right ending balance. So I really hope this has helped, and I wish you luck.